Somewhere in your financial structure, there is a contract you signed when interest rates were different. Your credit profile was different and your asset base was different. That contract is still executing its original terms every single month, automatically, silently, and potentially at a significant premium to what the market would charge you today. The question is not whether refinancing is complicated. The question is how much capital you are leaving on the table by treating your mortgage as a fixed variable instead of an active financial instrument. Most business owners optimize their operating expenses quarterly. They renegotiate supplier contracts, audit software subscriptions, and restructure vendor terms when market conditions shift. But the largest fixed liability on their personal balance sheet, their mortgage, often sits untouched for years, accruing interest at a rate that no longer reflects their financial position or the current cost of capital. That is not conservatism, that is inertia. And inertia in financial structures always has a price. Here is the discipline required to evaluate this correctly. Your mortgage is not a personal obligation to be managed emotionally. It is a liability on your balance sheet, and like any liability, it should be priced as efficiently as the market allows. When prevailing rates drop meaningfully below your current rate, maintaining the original contract is not stability. It is a decision to pay a premium on borrowed capital that you do not have to pay. That premium compounds. Over 5 years, the differential between a rate that is 1.5 points above market can represent tens of thousands of dollars in excess interest. And the capital that could be deployed into your business, your investment portfolio, or your next acquisition. The starting framework for evaluating a refinance is the 1% rule. As a general benchmark, if current market rates are at least 1 full percentage point below your existing rate, the interest savings are likely substantial enough to justify opening the analysis. On a $400,000 mortgage, a 1% rate reduction translates to roughly $300 to $330 in monthly payment reduction, depending on remaining term. That is approximately $4,000 annually, before accounting for any tax implications or reinvestment of that freed capital. The 1% threshold is not a guarantee of viability. It is the filter that tells you whether the conversation is worth having. The second variable that determines your refinancing leverage is your loan-to-value ratio, your current outstanding loan balance expressed as a percentage of your property's current appraised value. This number is not static. Property appreciation, principal paydown, and capital improvements all work in your favor over time. An LTV below 80% is the threshold that unlocks the most competitive rate tiers and eliminates the requirement for private mortgage insurance, a cost that can represent an additional 0.5 to 1% annually on your effective borrowing rate. If your property has appreciated significantly since your original purchase, you may have substantially more negotiating leverage than your original loan terms suggest. Before any refinance conversation, know your current LTV. It is your opening position. Every refinance carries a transaction cost. Closing costs, which typically range from 2 to 5% of the loan amount, include lender origination fees, title insurance, appraisal, and legal processing. On a $400,000 loan, you are looking at $8,000 to $20,000 in upfront costs. This is not a reason to avoid the transaction. It is a variable to model correctly. The break-even calculation is straightforward. Divide your total closing costs by your projected monthly savings. The result is the number of months required for the interest savings to fully absorb the transaction cost. If your break-even point is 36 months and you have no credible intention of selling or refinancing again within that window, the transaction generates positive net present value from month 37 onward, indefinitely. If your timeline is shorter, the math changes. Run the numbers for your specific horizon before making the decision. The term decision deserves separate analysis, particularly for business owners who think in terms of capital allocation rather than monthly comfort. A 30-year refinance produces the lowest monthly obligation, maximizing your monthly cash flow and preserving liquidity for deployment into higher returning assets. If your business generates returns above your mortgage rate, the arbitrage favors the longer term, borrow cheap, invest the differential at a higher yield. A 15-year refinance carries a higher monthly payment but a meaningfully lower interest rate, typically 0.5 point to 0.75 point below the 30-year equivalent, and eliminates the liability in half the time. The total interest paid over the life of a 15-year loan versus a 30-year loan on the same balance can represent a 6-figure differential. The optimal choice is not universal. It is a function of your liquidity needs, your investment return assumptions, and your strategic timeline for the asset. The operational framework for this decision is identical to any other capital allocation analysis in your business. What is the cost of the existing instrument? What is the cost of the replacement instrument? What are the transaction costs of switching? What is the payback period? And does the timeline justify the move? Refinancing is not about getting a better deal. It is about continuously optimizing the cost of every liability on your balance sheet with the same discipline you apply to every other line of your P&L. Your mortgage was structured for a version of your financial life that no longer exists. Your income has changed, your asset base has changed. The cost of capital in the market has changed. The only thing that has not changed is the contract. And unlike most contracts in business, this one can be renegotiated. The cost of reviewing this analysis is 2 hours and a conversation with a qualified mortgage professional. The cost of not reviewing it is measured in thousands of dollars per year, compounding silently against your net worth. Capital efficiency is not a concept reserved for your business operations. It applies to every instrument on your balance sheet. Start with the largest one.